Hi everyone, welcome to another episode of the Patient World channel. In this episode, I'm going to go over the 10 reasons why I think Amazon stock price doubles from here. I am also going to reveal the passive income we received for September, which was a record month for us. Like this video and subscribe to the channel to help us grow and reach as many people as possible. And as always, before you make any financial decisions, please do your own research. Right, let's jump straight into the video. Before I jump into Amazon and why I think it's doubling from here, keep in mind that my portfolio has 31% allocation in Amazon and is my top pick as I'm recording this video. I came across many comments recently suggesting that investors are getting impatient with Amazon stock performance. The year-to-date performance is 1.4%, which is massively underperforming its peers and the market. The last 5-year stock performance is also a massive underperformance from Amazon. We have Amazon in red here, we have Microsoft in blue, Meta in purple, and Google in orange. And as we can see, Amazon returned 41%, Microsoft 145%, Meta 175%, and Google 230%. Amazon returned 100% less than the second worst stock, which is Microsoft, returning 145%. The stock price performance has underperformed, but let's look at what happened to the valuation multiples and the underlying business. Looking at the trailing PE, it went from 92 times back in September 2020 and is now sitting at 33. Forward PE went from 80 and is now sitting at 32. And meanwhile, diluted EPS went from $1.7 per share to now $6.6 per share, increasing by around 4 times. And cash flows from operation went from 55 billion to now 121 billion based on the last 12 months. So stock performance, yes, underperformed. However, the underlying business has performed extremely well. And at the same time, the P multiple went from between 80 to 90 back in September 2020 to closer to 30 to 35 times as of today. One of the reasons I think Amazon has underperformed recently is due to the fact that they are undergoing an extraordinary investment cycle. This chart here shows us the capital expense for Amazon in red, Microsoft in blue, Google is in orange, and Meta is in purple. Over the last 5 years, Amazon invested consistently more amounts in CapEx, and in most of the cases, it's around double the amount of the second bigger spender out of these 4 companies. Between 2020 and 2022, they doubled their fulfillment centers, and now they are investing heavily in this new growth opportunity, which is AI. I think Amazon's management has this unique ability to lean in when they see growth opportunities. As we've seen historically with the cash flow from operations, I expect these heavy investments to bear fruits for shareholders down the line. Okay, now let's look at Amazon businesses. The company did $670 billion in revenue in the last 12 months, and we have Amazon businesses split in online stores in red, physical stores in blue, third-party sellers in orange, advertising services in purple, subscription services in green, AWS in red, and other revenue in yellow. 3 things to highlight here. 1, all businesses are growing over time. 2, these are businesses that have tailwinds behind them and I expect them to continue to grow well into the future. And 3, the high margin businesses, which is third-party sellers, subscription services, advertising, and AWS, are growing faster than the lower margin businesses, which means over time, Amazon is becoming a higher margin business and a more predictable business, which should support a higher valuation multiple. Let's take a closer look at Amazon AWS. This is Amazon's AWS revenue for the last 12 months, and we can see it's growing steadily over time. And for the last 12 months, generated $116 billion. If you remember, during the last earnings period, Amazon stock fell by around 7 to 8% after Microsoft reported their earnings as Azure, their cloud segment, grew faster than AWS. In my opinion, the market is too concerned and short-sighted about AWS revenue growth. This chart shows AWS remaining performance obligations, and we can see that it grew by $6 billion quarter on quarter. To me, this shows that AWS is doing just fine, and as management highlighted many times, AWS is constrained by capacity. AWS is the leader in market share when it comes to cloud computing. Their revenue was $116 billion for the last 12 months, compared to Google's $49 billion and $75 billion for Microsoft Azure. So AWS remains the leader, and I expect them to remain the leader for the foreseeable future for a couple of reasons. Cloud computing usage has a long way to grow. This is a report from Blackstone where they talk about investment themes. investing in the picks and shovels of AI. The rapid rise and adoption of artificial intelligence is creating generational investment opportunities for private market managers to deploy capital into AI's picks and shovels, the foundational tools, infrastructure, and technologies that drive AI's development and adoption. And they showcased a graph on global data created, consumed, and stored. From 2010, it expects for this metric to increase by 197 times. Assuming we are here in 2025, we can see by 2028, only in 3 years, the amount can easily double. Given AWS is the leader in market share, I expect AWS to significantly benefit from this trend. AWS has millions of customers globally. The numbers vary based on how customer is defined, whether it includes businesses only or all individual account holders, but here are the key figures. The official AWS statements report having millions of active customers across virtually every single industry. So if you are bullish about, generally speaking, the world and how business grows over time, AWS will be a significant beneficiary of this growth. If one out of these million customers grows exponentially, AWS will benefit. And as we can see from third-party market research providers, the number of customers stands at about 4 to 5 million. This differs from the other two big competitors, which is Microsoft and Google. Google Cloud has this internal demand from their DeepMind division and their Gemini models, and Microsoft had this unique arrangement with OpenAI where the majority of OpenAI usage was going through Microsoft. And Amazon is also trying to do this, searching for their big customer. Let's go through key elements of this report. Searching for an anchor customer. More important to AWS XPU business growth is the ability to secure anchor customers, the market makers in this first wave of GenAI demand. Scale, time to market, deep partnerships, and pricing are key to winning these accounts, more so than advanced software layers. No firm better illustrates this than Microsoft. Azure's AI outperformance over peers is entirely driven by its OpenAI partnership. As of Q2 2025, all of OpenAI's $100 billion cloud spending is booked by Azure. Amazon understood early on the need for an anchor customer and invested $1.25 billion expandable to $4 billion in Anthropic in September 2023. The partnership expanded in March 24 with Anthropic committing to use Trainium and inferential chips. In November 24, Amazon invested an additional $4 billion into Anthropic, with the latter naming AWS its primary LLM training partner. Amazon's bet has been the right one. Anthropic is the clear outperformer in 2025 in the GenAI market, with revenue surging from $1 billion to $5 billion annualized. In this context, AWS's underperformance understandably frustrates investors, but they are misunderstanding the composition of Anthropic spending on training and inference. This chart shows how fast Anthropic grows relative to OpenAI, which is currently the leader in Gen AI. There are two clear reasons explaining why Amazon isn't yet truly benefiting from its relationship with Anthropic. One, as of Q2 25, Anthropic's cloud spending is over 2 times smaller than that of OpenAI, and a large share of Anthropic's spending is going to Google Cloud, one of Anthropic's first major investors and preferred cloud partner in 23-24 before they expanded the deal with AWS. Okay, so why is this going to change in the near future? We believe that most of Anthropic's skyrocketing inference needs are served by Google Cloud. Having the world's best inference system TPUs is a key competitive advantage. This is changing. The AWS infrastructure build-out is aimed at taking a chunk of this for its key customer, while also focusing on training. While Anthropic makes less headlines than peers like OpenAI, xAI, and Meta, it's all in on the AGI race and isn't planning to be shy on training spending. Their belief will materialize as early as this year. We show below 3 AWS campuses in final stages of construction, boasting over 1.3 gigawatt of IT capacity for the sole purpose of serving Anthropic's training needs. The speed of construction is remarkable. AWS is throwing money at building IT capacity so that they can serve Anthropic, which means they are going to be capturing more of their AI spend going forward. So what's Anthropic doing? They continue to expand globally. Today, we are announcing Anthropic's expanded global presence with key leadership appointments, enterprise customer momentum, and new international offices across multiple continents. This expansion reflects Anthropic's growth trajectory and increasing international demand for Claude. Anthropic has the top market share in enterprise AI, and our run rate revenue has grown from 87 million at the start of 2024 to over 5 billion in August 2025, making us one of the fastest growing technology companies in history. Anthropic's recent economic index report found that nearly 80% of consumer Claude usage comes from outside the United States, with per capita usage in countries like South Korea, Australia, and Singapore outpacing that of Americas. Okay, so we know that Amazon has millions of customers. They are actively trying to anchor Anthropic, growing fast internationally. They are bringing 1.3 gigawatts of IT capacity specifically for Anthropic, and data creation and usage, as we've seen from Blackstone's report, is expected to double from today to 2028. However, there is also another aspect of this AWS Anthropic collaboration. Trainium's memory bandwidth per TCO advantage. So what is the total cost of ownership advantage because of Trainium chip? In the table below, we incorporate TCO in the comparisons. Trainium 2 is highly competitive on a TCO per million tokens. As we can see, Trainium has an advantage on the TCO per memory bandwidth as per the two tables here for both Trainium 2 and Trainium 3. Trainium 2's memory bandwidth per TCO advantage is key to understanding Anthropic's choice. While NVIDIA's chips and systems are better on most fronts, Trainium 2 fits perfectly into Anthropic's roadmap. They are the most aggressive AI lab on scaling post-training techniques like reinforcement learning. Anthropic's ramp will make it not only the only large external end user of Trainium 2, it will also be materially larger than Amazon's internal leads such as Bedrock, Alexa, etc. They are now heavily involved in all Trainium design decisions and essentially use Amazon's Annapurna Labs as a custom silicon partner. This makes Anthropic the only AI lab alongside Google DeepMind benefiting from tight hardware-software co-design. So what Amazon is doing here is essentially trying to lock in a big customer like Anthropic, but I wouldn't be surprised if this serves as a flagship project that Amazon can attract additional large customers down the line. As we move from training to inference in the AI race, this becomes more important as costs matter. Now let's move into the advertising services of Amazon. This chart shows that Amazon had $61 billion in sales coming from advertising over the last 12 months as of Q2 2025. The CAGR for this division since June 21 is 23.7%. As far as Amazon's ecosystem continues to grow, advertising has a long way to go. Let's look at an example. Meta is a pretty good example for a pure play on advertising revenue. Here we have Meta's annual revenue from advertising between 2019 and 2024. As we can see, their CAGR was 18%. Meta is a mature, established advertising giant that managed to grow their revenues by 18% since 2019. Meta's revenue from 2019 was $69.6 billion, whereas Amazon's last 12 months revenue from advertising today is $61 billion. This suggests that Amazon's advertising revenue can continue to grow in high teens for the foreseeable future. There are a couple of factors that will help this growth continue. Firstly, it's improvement. Amazon needs to improve their integration in Prime Video. If you're someone watching Prime Video, it is very clear that Netflix is integrating ads much better than Amazon. And secondly, I believe advertising on the Amazon platform is much more valuable compared to a Meta advertisement. This is because Amazon's ecosystem is much more valuable. You can show an ad to someone that is already searching for a product and not show up an ad randomly in Facebook or Instagram to try and get them to click and find a product. So advertising on a platform where someone is already searching for a product is much more valuable than randomly showing an ad in a different platform. I expect advertising revenues to continue to grow in high teens over the coming years. Let's look at subscriptions. Subscription revenue stands at $46.7 billion for the last 12 months and grew its revenue at a CAGR of 15.7% since September 2020. In my opinion, Amazon Prime is one of the best value proposition subscription services out there, which in my eyes translates to strong pricing power. Amazon will be able to raise prices over time without customers canceling these subscriptions. As a result, I expect continued growth in Amazon's subscription services, and incremental revenue can drop straight into the bottom line of the business, increasing the profitability of Amazon as a whole. Okay, why do I think Prime membership offers the most value proposition out there? You get fast, free delivery. In the US, more than 300 million items are available with free Prime shipping, and tens of millions of the most popular items are available with free same-day or one-day delivery. Amazon's delivery offers convenience and low prices. In the US, that means Prime members saved on average over $500 on their deliveries last year. You have entertainment benefits. Prime Video is a first-stop entertainment destination offering customers a vast collection of premium programming in one app available across thousands of devices. Prime members can customize their viewing experience and find their favorite movies, series, live sports, including Amazon MGM Studios produced series and movies, licensed fan favorites, and programming from Prime Video and add-on subscriptions. They offer Amazon Music, Prime Gaming, Amazon Photos, Amazon Kids Plus, Kindle Books. You have shopping benefits, which includes Prime member exclusive deals, Prime Visa, and so on and so forth. Prime memberships offer a vast array of benefits, and their cost is reasonable. In the US, anyone can join Prime for $14.99 per month or $139 per year. This seems pretty reasonable when you account for all the benefits you are getting, and I expect management to have increased pricing power as this array of benefits continues to increase over time. Now let's look at their online stores. Online stores revenue was sitting at $256 billion as of June 25 for the last 12 months, and we can see slowly increasing over time, and since September 2020, revenue increased by close to $100 billion. The online store is a low margin business as of today. However, fulfillment is becoming faster and more cost effective, helping margins. Amazon is the second largest private employer, employing 1.5 million full-time and part-time employees. And we already know and have been told by management that workforce numbers will come down over time, helping margins further. We have this recent memo from June 25 from Andy Jassy stating, as we roll out more generative AI and agents, it should change the way our work is done. We will need fewer people doing some of the jobs that are being done today and more people doing other types of jobs. It's hard to know exactly where this nets out over time, but in the next few years, we expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company. And we are not only seeing this in their recent memo, but also in the recent earnings report. Amazon's fulfillment centers demonstrate a high and continuous advancing level of maturity characterized by strategic network re-architecture, significant operational efficiencies, and deep integration of advanced technologies. The re-architecture of the US inbound network into a regional structure has been pivotal, enabling inventory placements closer to customers. This has resulted in a 12% reduction in average package travel distance and nearly a 15% decrease in handling touches per unit, while increasing the share of orders moving through direct lanes by over 40% year over year. These improvements collectively enhance delivery speed and lower operational costs, reflecting a sophisticated approach to logistics and supply chain management. Further evidence of this maturity is seen in the achievement of global speed records, with Prime members receiving deliveries at their fastest speeds ever. In the US, 30% more items were delivered same day or next day compared to the prior year, and the company is expanding same day and next day delivery to thousands of smaller cities and rural communities. This extensive reach and rapid delivery capability are underpinned by advanced automation and robotics. The deployment of the 1 millionth robot across the global fulfillment network, alongside innovations like automated package sorting and the Deep Fleet AI system, which boosts robot travel efficiency by 10%, highlights a commitment to technological leadership. These systems not only drive cost efficiencies and faster delivery, but also improve workplace safety by automating physically demanding tasks. While substantial progress has been made, the ongoing investment in robotics and generative AI indicates a strategic vision for continued evolution. The combination of these technologies is described as just getting started, suggesting that the current state of maturity, while advanced, is a foundation for even greater sophistication and efficiency within fulfillment operations in the coming years. This continuous innovation underscores a mature yet dynamic approach to optimizing the fulfillment network for both customer experience and cost structure. So in other words, AI and automation will make online store businesses a higher margin business than what is today. Given the size of the top line, I expect this to be a material contributor to the bottom line. Okay, now let's look at the smaller projects, but in my opinion, projects that can provide significant growth opportunities for the business. Starting with Project Kyber. Project Kyber is Amazon's initiative to provide fast, reliable broadband to customers and communities around the world, including in places that are currently unserved or underserved by traditional internet and communication options. To achieve this, Amazon will deploy thousands of satellites in low Earth orbit, linked to a global network of antennas, fiber, and internet connection points on the ground. Billions of people around the world don't have reliable access to broadband. Poor connectivity means limited access to modern communications, education, health services, and other important resources, which can create an economic disadvantage for unserved and underserved communities. So why is Amazon undertaking this? You don't have to travel far from major cities to lose internet connectivity. It can happen within a 60-minute drive from Amazon's headquarters in Seattle. Cost, complexity, and geography can make it difficult to install traditional, ground-based fiber and wireless connectivity solutions in these areas. What Amazon is doing is expanding their total addressable market, which is very well known that they are able to do. Recent commercial deals for Amazon Project Kyber include an agreement with JetBlue in September 25 for in-flight Wi-Fi services on their aircrafts, a deal with NBN Co. in August 25 to provide wholesale fixed broadband services to rural and remote areas of Australia starting in mid-26. And Amazon also partnered with Airbus to integrate Kyber's connectivity into its aircraft catalog, as well as with Vodafone for a potential project in Europe and Africa. So we have seen interest from industry for Project Kyber, which will lead to incremental cash flows from this business. Project Kyber also offers the possibility of cross-selling. Let's take an example of AWS. For business and government clients, Project Kyber offers advanced optional services for greater control and privacy. Private connectivity to AWS. The network offers a service that allows customers to move data directly from a remote location into AWS, bypassing the public internet entirely. And sovereign control. For government clients like the US Department of Defense, Kyber ensures sovereign control over data, addressing concerns about where data is stored and routed. So suddenly, once you can offer these private networking options as one company, you might be able to accelerate AWS sales. We don't have the list of AWS clients, but let's look at this example here. Kazakhstan will soon have access to high-speed internet in areas currently lacking service, thanks to a new agreement announced on September 22 between Amazon's Project Kyber and Kazaki Telecom, Kazakhstan's telecommunications operator. The partnership will bring high-speed satellite internet to communities throughout Kazakhstan, marking a significant step in bridging the digital divide in Central Asia's largest country. If Kazaki Telecom is not part of AWS, I am pretty sure that they are more likely to be part of AWS if they have a very good experience with Project Kyber. Another cross-selling opportunity is Prime membership. If customers are based in low internet connectivity areas and Amazon incorporates Project Kyber internet services in a Prime membership, it's more likely for those customers to join as subscribers, and Amazon will be extracting more value from them over time. So Project Kyber can help other Amazon business segments to accelerate growth. Next up, we have Zoox. Amazon is in the robotaxi race with his subsidiary Zoox, which recently launched free robotaxi rides in Las Vegas and is also testing its unique bi-directional self-driving vehicles in Washington, D.C. The goal is to eventually offer paid services, but regulatory approval is needed to begin charging for the rides. So again, I see it in two ways. Firstly, incremental cash flow generated from paid rides, and secondly, how can this robotaxi technology help Amazon improve other businesses? Zoox can be the first point of contact for introducing Amazon to more people as they join in their free or paid rides. Zoox can also be incorporated in the benefits of Amazon Prime, which will attract more users. You can enhance your advertising as you have another touch point with people. But most importantly, this technology, I believe, it's the early stages of autonomous delivery and the increased use of robotics. In 5 to 10 years, you might not need delivery delivery drivers because of Zoox-like technology that will be able to deliver items to people's doorsteps. If that happens, Amazon's profitability improves materially. Next up, we have Amazon Pharmacy. Amazon Pharmacy is a full-service online pharmacy that delivers prescription medications directly to customer stores in the United States. Amazon has the scale and distribution to sell this product to many people. Why do I think this segment continues to grow? Affordability. Amazon's pharmacy provides transparent pricing, showing you your insurance copay and other available discounts. It also offers specific programs designed to lower medication costs. Convenience. It eliminates the need to visit a physical pharmacy by delivering medication directly to your home. You can manage and track your orders online and set up automatic refills for eligible prescriptions. Pharmacy support. Licensed pharmacists are available 24/7 to answer questions about your medications. And lastly, PillPack by Amazon Pharmacy. For those with multiple chronic conditions, this service sorts medications, vitamins, and supplements into pre-sorted daily dose packets. It's an extension of Amazon's pharmacy services. This summary here perfectly explains Amazon's approach, which is affordability and convenience for a price. And lastly, we have what I call the management's switch. Currently, management is focusing on growing the business, expanding the total addressable market of the business. The company started with selling books and they now sell internet from space. Just think about that. That's the mentality of management. So I think it's down to management to flip the switch and become quote-unquote shareholder friendly. Control CapEx, which has exploded over the last years. Do some share buybacks. As of now, they are diluting shareholders marginally. Perhaps pay a small dividend, which they don't do for now. And continue to control stock-based compensation. That will be an incremental positive for the stock price, but let me be clear. I'm okay if they do not do that and invest heavily in business segments they think will prove to be material contributors to the business down the line. So that's my 10 reasons why I think Amazon stock doubles from here. And let's look at the Morningstar report. Amazon is a leader in e-commerce, public cloud, and digital advertising. Amazon dominates its served markets, notably for e-commerce and cloud services. It benefits from numerous competitive advantages and has emerged as the clear e-commerce leader given its size and scale, which yield an unmatched selection of low-priced goods for consumers. The secular drift towards e-commerce continues unabated, with the firm continuing to grind out market share gains despite its size. Prime ties Amazon's e-commerce efforts together and provides a steady stream of high-margin recurring revenue from customers who purchase more frequently from Amazon's properties. Through AWS, Amazon is also a clear leader in public cloud services. Additionally, the company's advertising business is already large and continues to scale as ads have made their way into Amazon's streaming outlets, thus offering an attractive option for marketers looking to access a vast audience with a variety of data points about those very consumers. AWS and advertising growth should continue to outpace e-commerce growth and should be the main growth drivers over the next 5 years. This is critical as each of these segments drives higher margins than the corporate average, which in turn should allow both operating profit and EPS to outgrow revenue as margins continue to expand. From a retail perspective, these are online stores. We expect continued innovation to help drive further share gains in a post-lockdown world. We also look for continued penetration into categories such as groceries and luxury goods that have not been previously translated into the same level of success as other retail categories. We see technology advancements in AWS and a bigger push to service enterprise customers as helping to maintain the company's lead there. Overall, we see good revenue and free cash flow growth for years to come. Let's look at the bull and bear's case. The bulls say Amazon is the clear leader in e-commerce and enjoys unrivaled scale to continue to invest in growth opportunities and drive the very best customer experience. High margin advertising and AWS are growing faster than the corporate average, which should continue to boost profitability over the next several years. Lastly, Amazon Prime membership help attract and retain customers who spend more with Amazon. This reinforces a powerful network effect while bringing in recurring and high margin revenue. And what do bears say? Regulatory concerns are rising for large technology firms, including Amazon. We've seen their recent settlement of $2.5 billion with the FTC. Further, the firm may face increasing regulatory and compliance issues as it expands internationally. New investments, notably in fulfillment, delivery, and AWS, should damp free cash flow growth. Also, Amazon's penetration into some countries might be harder than in the US due to inferior logistic networks. Amazon may not be as successful in penetrating new retail categories such as luxury goods due to consumer preferences and an improved e-commerce experience from larger retailers. On economic mode, we assign a wide mode rating to Amazon based on network effects, cost advantages, intangible assets, and switching costs. Amazon has been disrupting the traditional retail industry for more than 2 decades while also emerging as the leading infrastructure as a service provider via Amazon Web Services. They believe Amazon's retail business has a wide moat stemming from network effects associated with its marketplace, where more buyers and sellers continually attract more buyers and sellers. There is also the benefit of a cost advantage tied to purchasing power, logistics, vertical integration, brands, own delivery, and so on, and the negative cash conversion cycle and intangible assets associated with the technology and branding. We also believe AWS is a wide moat business thanks to high customer switching costs, a cost advantage associated with economies of scale where few competitors can keep up with Amazon's investment pace, and we have seen this in the video earlier on, intangible assets arising from semiconductor and facility development, and the network effect associated with a marketplace for software created to make AWS work better. They assign Amazon's advertising business a narrow mode based on intangible assets from its proprietary data on hundreds of millions of users, and the network effect, again focusing on buyers and sellers meeting in the largest available venues. We believe that the wide mode for Amazon's entire business is greater than the sum of its parts, as the company segments reinforce one another and returns result in an unrivaled consumer experience. Some other key points that I think reinforce the ideas that I shared earlier. We believe it is cheaper initially for companies to move workloads to the cloud, as there are fewer upfront costs and lower bar to clear for maintenance and administration. Additionally, Amazon has devoted significant R&D resources to adding advanced features to the platform. Along those lines, AWS offers scale advantages to clients in that it is cheaper and faster to set up IT infrastructure in the cloud compared with undertaking the same effort independently. So it is cheaper for customers to jump on AWS, making it easier for AWS to attract customers. Customers also benefit from the ability to scale up compute power for burst requirements, paying for only what they need and having it available effectively on demand. We have seen some of the largest technology companies in the world simply fail to keep pace with Amazon's massive investments in infrastructure as a service over the years, and AWS's cost advantage over its rivals is obvious. Those firms struggle to compete in a meaningful way against AWS. This reinforces the idea that AWS has some competitive advantages that will help them grow into the future. Amazon has amassed significant technology and process knowledge, which we believe it is an intangible asset for the firm as a whole and for AWS. Additionally, the firm designs its own semiconductors, which are used to power its server arrays, and also developed proprietary robotic automation technology used in its fulfillment centers. And I will close with this on Amazon. We think network effects, intangible assets, cost advantages, and switching combine to form a powerful mode for all of Amazon. We think many of these areas reinforce one another and see little difficulty in Amazon continue to deliver returns on invested capital well in excess of its cost of capital over the long term. So that's my take on Amazon. Amazon is my largest position in my portfolio. Let's see where we go from here. Finally, let's look at the passive income we earned over September. Last month was a record for us as we earned £926 in passive income, or £30 to £31 every single day for the month of September. The breakdown was we earned £2.76 from the Google dividend, and the rest come from savings accounts. Approximately £480 came from a fixed saving account that we have that pays once a year, hence the spike you see every September, and the remaining interest was earned based on cash saved in the Trading 212 cash ISAs. Over the quarter, we earned 1.9k in passive income, and for the last 12 months, our passive income total was £5,120. This is the outcome of luck, hard work, and consistency. I expect the passive income growth to slow down as we invest more in growth stocks, but overall, we are very happy. That's it for this episode. Like the video, subscribe to the channel, and I'll see you in the next one.